Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Friday, January 6th, 2022. It's great having you with me here today, and we got the employment number, and it was a healthy, solid gain for employment. Remember, we look at it both in terms of a household survey and the establishment. The establishment's the one we take the non-farm payroll jobs up 250,000 roughly. That tells you that we continue to move along. The chair of the Federal Reserve, Chair Powell, has commented that strong employment is anything over 100. We did that 2.5 times. So looking down the categories, we see leisure, we see medical doing better. That's helpful. But that's where we actually start seeing the rub here today. We see the rub in terms of the wage growth. And we actually see that slow down a little bit because we're seeing jobs, not the high paying jobs, growing as much. High paying job categories, business services, finance, information services, all kind of on the weaker area. So there is some adjustment going on there. There's also a numerical element that you have to see, which is the fact that last year in December, we saw a healthy raise of 5.5. 0.3 is going to kind of move down the number. We've also are going to see that as we move forward in January. However, the February number is 0.1, so maybe a push up in terms of the reading. So kind of, clearly signs of less wage inflation. That helps the Fed as it looks forward and probably gives them a little bit more of a fair way to not raise rates as high. Yes, quarter point is coming. The end of this month, but probably not the half, probably, more cautionary tone because we've seen better numbers in the inflation area. Particularly alarming is the household survey. We see the available labor pool fall. It's really coming in roughly about 10 million. Now, this is a statistical element, but what it's telling you is we had a shot up of employment there. We actually look at two different readings. It's a little more volatile, but the household survey actually tells you if people have 1 or 2 or 3 or 4 jobs where the establishment doesn't. So what did we see there? We saw a fall in the unemployment rate because more people had jobs. We see U6, which is that I'm looking for a job. I have one now, but I'm doing part-time. I'm looking for more opportunities to use my skill sets. That's at 6.5, very low reading. So the availability of workers, that skill set element continues to be a problem that did not get erased. And even if we think about the Fed tightening, we still have that long-term problem that we're facing. So a healthy number. We actually, across the border, got similar that out of Canada. Canada and the U.S. economies at certain points are tied. So that's actually, I think, a strength, another positive for the U.S. economy and as we move forward. So yeah, healthy labor market should spur on good spending, good consumption by the consumer, and the GDP number for the fourth quarter looking at roughly 4%. As we move through the year, yeah, we should see some weakening. We see residential construction becoming very weak. We do think that there's going to be some issues with, being price shocked on services. We continue to think that sort of the good side of the equation has really fulfilled some of its demand. We saw that in the ISM numbers. Pent up demand. So we think that that's sort of working our way out of the economy. So there are danger signs ahead. However, the real fuel employment is continued to be solid, and we think that's a good harbinger. So thinking about the Fed will increase rates, we're moving towards a little economic weakness, a little bit of soft landing. And at that point, we think that inflation will be mitigated and we can look ahead to lower rates ahead. I think that will be helpful. This is Scott Murray for the Daily Economic Market Shout. Thanks for your time and have a good weekend.